Hi, Jim Gore from THOR Wealth Management. If you're under the age of 50, you've never really experienced inflation. And that's shown on this chart. This is looking at global inflation rates from 1980 to today. And you can see that the annual rate of change in inflation has gone down significantly since the 1980s. Notice one thing, last time we saw a pickup in inflation rate was back in 2007, 2008. Then it's come down since that time period. It is starting to go up, and we think it's going to go up more because if you look at that time period, last time it went up, that goes right in line with what we saw with energy prices, especially looking at natural gas. Natural gas, you can see from 2006, went up in 2007, 2008, and then dropped dramatically. The drop came about specifically because of technological advances. I'm talking about fracking. Because of fracking here in the United States, we went from 20-year supply of natural gas to a 200-year supply of natural gas. So you saw natural gas prices drop dramatically. Because of natural gas prices dropping dramatically, energy costs went down, and that brought down the rate of inflation since 2006. However, note that the last year we've seen natural gas prices spike up, and we think that's going to continue. The main reason for that is supply and demand. Demand right now in the United States, we are 7% below where inventory should be at this time of year going into winter. In Europe, it's even worse. It's 16% below where it should be. Demand is going to be there. If we have a strong winter here in the United States and Europe, there's going to be more demand for natural gas, but we don't have the supply for it because a lot of the rigs have come down because of what happened in March of 2020 when energy prices collapsed. So you're going to see more demand at a time when supply is not as great as it used to be, which means we're going to have higher energy costs. If you have higher energy costs, you will have higher inflation. That's what happened in the late 70s, and that's why we don't think this is transitory. But inflation is very important for everyone to be aware of how it can eat into your purchasing power. And this is a chart that looks at what a dollar started at when the Federal Reserve first started in 1913 to what it is today. So a dollar back in 1913 is really worth 5 cents today. So we saw 95% depreciation of the dollar since 1913. So it's not something that you want to hold a lot of cash for a long period of time because you will be losing money and losing purchasing power of those investments. We think that it's going to be compounded, the inflation rate, because you look at the monetary base here in the United States, you can see that we've really increased, the Federal Reserve has increased the monetary base significantly in 2009, 2010 with all their quantitative easings that they've done throughout the years. And you can see how it spiked up during COVID. And since 2007, the monetary base is sevenfold what it used to be back in 2007. So that's pretty dramatic. So you're going to see higher inflation. So what does an investor do? Well, investors right now should have uncorrelated assets that are not correlated to the stock or the bond market, having commodity-based investments, but being diversified as well. Having money overseas is also very good at this time because if we're increasing the dollar more than they are euros, the dollar will go down versus other currencies. But this is also a time that you don't want to hold cash because over the next 5 to 6 years, you will be losing that purchasing power that money has sitting at the bank. Hope everyone has a great 2 weeks here, and we'll talk to you soon.